Hey everyone, it's Mike from Order Flows, and welcome to this presentation on trading the China futures markets with order flow. A question I get asked every so often is, can I use order flow on the Chinese domestic futures markets? And the answer is yes, you can. I'm going to show you how to do that in this presentation. Now, before I get started, a brief disclaimer. There is risk in trading. Don't trade with money you can't afford to lose. Now, I'm really excited about this presentation because for many people, especially people in China, order flow is a new concept to them. And today's presentation is like going to Disneyland and not having to wait in line. I'm going to give you the fast track path to learning the latest in market analysis and trading, which is order flow. Now, order flow is going to enable you to see things in the market other traders are not aware of before they see it. More importantly, how to profit from it before anyone else does. Now, before I get into it, I just want to introduce myself if you're new to orderflows.com on who I am. This is my picture. I'm going to talk about my background just so you understand where I've been in my trading career. So in 2015, from 2015 till now, I started orderflows.com, which is my software and training company. But prior to that, 2006 to 2012, I was vice president of futures trading at JP Morgan in Singapore. I sat on the trading desk from 5:30 in the morning till 4:30, 5 o'clock at night trading, sitting in front of the trading screen. That's what I did. I didn't sit in some corner office and look at spreadsheets and stick my head out and look at the trading desk and say, oh, I think you got too much risk on. No, I was the guy sitting there staring at the market, entering the trades, trading. From 2002 to 2005, I ran the futures and options trading desk at Cargill. If you're not familiar with Cargill, it's the largest privately held company in the United States. It accounts for about 25% of the meat exports, about 30% of the grain exports in the United States. But Cargill is involved in everything that you can imagine, anything commodity based, energies, obviously agricultures, and everything you can imagine. They're involved somehow in it. From 1998 to 2001, I was a licensed Eurex trader at Commerzbank, the big German bank. Where we traded DAX, Euro stocks, Bunds, Babel, Schatz, the whole yield curve. And we traded also against the U.S. contracts, the U.S. 10 years, the E-minis, and the NASDAQ. From 1997 to 98, I was a global macro trader at EDF Man. EDF Man is an English company, much like Cargill, a commodity trading company. It's been around since the 1700s, trading, they got their start trading sugar, of all things. From 1994 to 1997, I was with Dean Witter. I started on the CME floor, and then eventually I left the floor when electronic trading was gaining a foothold in the marketplace. The floor, I thought, is great. I love the floor. I wish they were still open. But when I saw what was happening on the screens electronically, I thought, that's the future. That's where I want to be. So I left the floor to trade off the floor, and it was a big adjustment because I went from trading one or two markets to all of a sudden having to trade 50 markets on the screen. And in 2000, I had mentioned I was with JP Morgan from 2006 to 2012. And, in 2007, when JP Morgan opened up their joint venture with Zhongzhan Futures, who they bought in order to gain a foothold, we became the first foreign bank to have a brokerage company and trading company in China. It was the JP Morgan China joint venture with Zhongzhan Futures. That's me there in the middle. The guy in front of me who doesn't like me anymore, he runs City Futures, I believe now, and Nick here is head of OTC trading. I think he's still at JP Morgan. And Richard Chen, I think he still heads up the China JP Morgan China company. This was the staff for our China office there. In China, there are 4 commodity futures exchanges. The first one I'll talk about is the China Financial Futures Exchange, which trades the index futures, which is the CSI 300. They now have a CSI 500. These are their index futures. And you can see the daily volume is pretty decent. 100,000 on the CSI 300, 83,000 on the CSI 500. They also trade some bonds, but volume isn't that, it's all right. 32,000 on their 10-year bond futures is okay. Then they also have commodity exchanges. They got 3 commodity exchanges. They have the Shanghai Futures Exchange, which trades base metals, precious metals, energy, chemical futures, even metal futures like rebar steel. And you get the volumes here. Over 1 million contracts on rebar steel in a day. Open interest 2.5 million. Another exchange I have there is the Zhengzhou Commodity Exchange. It's also trades agricultural contracts and non-ag contracts. You can see Flat Glass trades 60,000 contracts in a day. And they also got their ag contracts on here. The other one is the Dalian Commodity Exchange. Okay, and it's more of an agricultural exchange, but they do have industrial contracts like coking, steel, iron ore, PVC, which is a big contract. But you see, this is their soybean meal. It trades 267,000 contracts in a day. Open interest is over 1 million contracts. 267,000. That's a lot more than the CBOT, CME contract trades in a day. Now, the software that I use is the OrderFlows Trader software. It's available from orderflows.com. Now, the data is very important. My data comes for China comes from ostrader.cn. And, as far as I know, they're the only real-time data available for, for traders that want to look at a footprint chart. Now, the platform that the OrderFlows Trader runs on is the NinjaTrader 8. You can get it for free. You just go to ninjatrader.com, download the free version, and my software will run on that. So what is order flow? Order flow refers to the orders coming into the market, how they're being filled, whether executing on the bid or at the offer. Order flow looks at the market auction price process at the micro level and allows you to determine how trade is being facilitated in either direction. Now, we deal with order flow daily. We don't realize it, right? When you go to the market to buy fish, you participate in a two-way auction, right? You have a price that you want to pay in your head. You're thinking, I want to pay, I want to buy this fish, but I don't want to pay, more than 5. But the seller has a price he wants to sell it at. Maybe he wants to sell it at, at 7. And you and the seller go back and forth until you agree on a price and complete the trade. Maybe you have to go up to get the fish, right? You got to go pay 6 for it, and the seller has to come down from 7 down to 6. You don't want to pay more than you have to. The seller doesn't want to sell it at less than he has to. Now, the same is true with the futures markets. In the course of the trading day, prices go up and prices go down. You won't buy a fish at a stall when you know you can buy the fish for cheaper at another stall for less, right? This forces the seller to lower his price to get you interested in buying fish from him. So the same things that work in the futures market, in the commodities market, is what you deal with every day, in your everyday experiences, whether you're buying fish or, you're buying a car. It's the same sort of thing. Think about it, right? If the fish seller has 10 more boxes of fish in his truck and the other sellers also have a lot of fish to sell, and there's a little interest in people buying fish, the seller is going to aggressively lower his price on the fish to sell it as fast as he can. Right? He might make a smaller profit by doing that. He might break even. Maybe he takes a loss, right? But he'd rather take the small loss or small profit or break even than wait till later and take a big loss on the fish because he can't sell them, right? And he has to throw them out. No one's going to buy fish if it's smelly and, slimy. So, the seller would be happier to take a smaller profit or even break even on what he paid for the fish to get it off his shelves. So, in the wet market, right? What goes on there in the wet market, right? If you think the price of fish is going up and you need them for dinner tonight, you buy them now, right? You're the buyer, right? You got to buy it. If you think the price of fish is going down and you need them for dinner, but you can wait for the price to come to you, you're going to hold off, right? You're still buying it, but you're willing to wait for your price. So if you're the seller now, right? If you think the price of fish is going up and you're selling them, you slowly increase your price as you sell some. You sold some, you raise your price a little bit more. You still see people are interested, then they buy it from you at your higher price. You back off, you move your price a little bit higher. People are still interested. You go higher. You're not going to sell everything for that low price because in your head, you're thinking, wow, my price is high already. I paid 5 for these fish, but I'm able to sell them at 9, and people are very interested in buying this fish, so you move your price to 10. You see people are still interested. They're not afraid to pay that price. You move it up to 11. People are still interested until you get to a point where people no longer have interest in paying such a high price. Then you start moving your price down, right? If you think the price of fish is going down and you hold a position, you sell them now, right? And it's the same thing in the commodity markets as what you go through in the fish market, right? Whether it's instead of fish, right, think of it as like gold or eggs or fuel oil. If you think the price is going up, you buy gold now, right? If you think the price of gold is going up and you're selling it, you slowly increase your price as you sell some and you keep selling some more as the price goes higher until you realize that nobody's interested in buying gold from you at these higher prices. Then you start lowering your price. If you need to buy gold, if you think the price is going down, right, you decide what price you want to pay and you wait for it to come to you. Now, if you think the price of gold is going down and you hold a lot of gold coins, right, you sell your gold now before it starts going lower. So what you're doing in the fish market is the exact same thing in the futures market. So an order flow chart, this is what an order flow chart looks like, right? Most people are familiar with a normal candlestick chart. And you can see actually my order flow chart has a candlestick inside in the middle. So you can still see what the candlesticks look like. I mean, most people are visual, right? They're used to looking at candlesticks. But what order flow does is it takes the volume traded on the bid, the volume traded on the offer, which I'm going to explain in a minute, and it puts it on the chart so you can see areas where there are big sellers or where there's lack of selling or lack of buying. And from that information, you can start seeing patterns developing, patterns in what's trading in the market, where buyers are interested, where buyers are not interested, where sellers are aggressive on lowering their price, or where buyers are aggressive in buying more. There's a lot of information you're getting off this chart that's just not available on a normal bar chart. This is a gold chart here, okay? So you can see here, you hit this high, right? This green line up here is the high of the day. But what's happened? All right, you hit your high of the day and the market starts coming off, right? And if you can, it's one thing to look at a chart after the fact, but when you're looking at a chart in real time, and I can see on this way up, I see there's a lot of aggressive buying, which I'll talk about later. But then why does this market turn around? Well, it turns around for a couple of reasons. Buying has gotten weaker, right? As I was discussing earlier, right? If you're a fish seller and you bought your fish at 5 and then you put the price on to sell your fish at 7, people are buying it, and everyone's crowding around your stall buying it. Maybe you start raising your price a bit more to 8, and people are still, hey, take my money, you move your price to 9. People are still rushing you. Okay, you move it up to 10. You're thinking, hey, I'm going to go on vacation now, I'm making so much money. But you're going to get to a point, maybe at 13, people don't want to buy it anymore. Okay, then buyers start losing interest at those higher prices. And then you as the seller are going to come in and say, okay, I'll go back down to 12, back down to 11, back down to 10, 9, 8. And that's what causes the market to go down. And I could see it on an order flow chart. I can see exactly what's happening on an order flow chart. I can see how the aggressive buyers are coming in here because they think prices are going higher, and the sellers keep moving their offers higher. And then it gets up to a point where the buyers just aren't interested anymore. It's just too high. And then it starts coming off, and I can see areas where sellers are getting aggressive and they're lowering their prices, whereas before here, the sellers were happy to sell it up here, on the way up, but then on the way down, now sellers are starting to panic. They're getting very aggressive in here. Think, oh my gosh, price is going down. I got to start selling it as fast as I can, lowering my price, and then the market goes down. Now, what makes order flow trading so powerful is that a trader can see inside the bar to fully understand what's happening in the market. And why is that important? It's because, a doctor uses an x-ray to determine what's wrong with a patient. Order flow allows a trader to see the underlying strength or weakness in the market. And again, if you're just looking at a normal bar chart like this, you're not going to see it. You're not going to see areas where traders are getting aggressive. And that's probably one of the most important pieces of information you're going to get from order flow is knowing where traders are aggressive. People like to talk about, I got moving averages, MACD. But, it's great when there's a big trend, in one direction. But a lot of times the market just does this. It goes sideways on you, and if you're trading with any sort of technical indicator like a moving average or a MACD or RSI, sideways action is what kills you. And most of the time, this is how the market trades. It trades in sideways action. People have done studies and say, the market trades sideways 70% of the time, trades in a range, 30% of the time it trends. Okay, well, yeah, when you catch the trend, that's a nice trade. No matter what you're looking at, it's going to give you a great buy signal or sell signal. It's this part where the market trades majority of the time where traders get killed. This is what kills traders in here, the sideways action. So what's the difference between using order flow and traditional trading indicators such as, moving averages, MACD, RSI, stochastics, DMI? Is those traditional trading indicators lag the market. They slowly catch up to the market. And if you ever do a study into how those indicators are calculated, you'll understand why. They take data from 30 bars ago. Well, what happened, if you're looking at a 30-day chart and you're looking at data from 30 days ago, what does that got to do with today? So much information has come into the market since then. It's probably not worth very much in the sense of, its value in analysis, and you're putting a lot of weight in that. But think about it like this, right? When you're looking at an indicator, right? First, what happens in the market? The market moves, right? Price makes a move, it goes up. Then the indicator makes a move to catch up with that price movement. And then you, the trader, you make a move. You get long or get short based on what happened in the indicator, based off of what happened in the price movement. So by the time you make your move, well, the market's already moved again. Oftentimes it's moved in the opposite direction. We've all experienced it. I'll be the first to admit, there's times I've bought the high and I've sold the low. That's just how it goes. But when you're trading with traditional indicators, you are just putting yourself, behind, I hate to use the term behind the 8 ball, but, you're putting yourself in a disadvantaged situation. Now, order flow allows a trader to make a move the instant price moves. You'll be able to respond to the market price movement well before retail traders who use traditional indicators do. Oftentimes your trading helps define the direction of the indicator movement. So what would you rather be? Would you rather be the person, at the front of the line deciding, okay, I'm going to take a step forward and everyone else is going to follow me, or be the person towards the back of the line that's just following? You'd want to be the person in the front of the line. Now, I mentioned earlier that the market is a two-way auction, right? There's a bid and there's an offer, right? So you can see here, this is how what it looks like. There's someone willing to buy at a certain price, there's someone willing to sell at a certain price. So like in here, you can see there's 280 contracts to buy at 1913.25. There's 565 contracts to sell at 1913.50. So there are different types of buyers, there's different types of sellers. Now, if this is the market, so to speak, it's 1913.25 bid, 1913.50 offer. If I come into the market and I just want to buy at the market, I want to get filled now. I said, I don't care what price, just get me done. I'm going to buy at the market. I'm going to pay 1913.50. I'm going to be the aggressive buyer. I'm going to be buying the offer price. Conversely, if I was the seller and I just want to get done, I want to get filled, I'll say sell at the market. I'm going to sell at 1913.25 because that's where the bid is, right? So I'll be the aggressive seller. Now, the other type of buyers and sellers are what is called passive sellers, passive buyers. The people that are working to buy at 1913.25, there's 280 contracts there. The 280 people that are trying to buy it here are passive buyers. The 565 sellers up here that are trying to sell it at the price of 1913.50, these are passive sellers. So you have passive buyers, passive sellers, aggressive buyers who buy from the passive seller, and you have aggressive sellers that sell to the passive buyers. And let's go back to the fish market, okay? Right? If you think the price of fish is going up and you need them now for dinner, you buy them now. You're the buyer. But what type of buyer, right? You are an aggressive buyer. Now, if you think the price of fish is going down and you need them for dinner, but you can wait for the price to come to you, you're a buyer. But what type of buyer are you? Well, you're a passive buyer because you're waiting for the market to come to you. You want to buy the fish, but you don't want to pay too much, so you're going to work a bid, right? You're going to say, okay, yeah, I'll buy the fish, but I'll only pay $5 for it. Then you start to walk away. Then the fish seller, hey, come back here. Okay, fine, take the fish. It's for $5, like that. If you're the seller and you think the price of fish is going up and you're selling them, you slowly increase your price as you sell some. Well, you're a seller, right? In this case, you're a passive seller. Okay, you're the passive seller. whoops, what happened? My word is seller, but it's passive. Is what's going on is you're waiting for the market to come to you. You're waiting for the buyers to come to you. It's like, for example, you're selling the fish. You got a price tag of 7 on it. Someone comes, I don't, the 7, that's too much. Can you go down to 6? No, sorry, no, price is 7. They walk away. They took prices elsewhere. They come back. You know that you have a good price. So, okay, price is 7. Okay, fine. The guy buys it from you. He's the aggressive buyer. Then, eventually that, my price is still lower than everybody else. You move your price up to 8, and then other people keep buying it. You're the passive seller. You dictate the price you want to sell it at. Now, if you think the price of fish is going down and you hold a lot of fish, right? You're the seller. You got a boatload full of fish. You sell them now, right? You just say, okay, what are you willing to pay for this fish? It's the end of the day, and you still got a lot of fish. Someone says, oh, I like the fish, but I don't really need it. Do I really want it? And the guy's like, well, I see your price of 5. I don't want to pay 5. That's too much. I've only got $4. You're the fish seller. Oh, sold. Here, I'll sell it to you 4 for 4. Okay, you are the seller, right? You are the aggressive seller. You go down to the price that the buyer wants to pay. So that's the difference between buyers and sellers. And that's how the difference is, in everyday life, how we view it, right? I just went through the fish market experience with you, but the same thing in the futures market, in the commodities market. And that's a very important concept that once you understand it, it makes trading a lot easier. It makes understanding what's going on in the market a lot easier. Now, an order flow chart is going to show me clearly what's happening in the market. I want to explain what all these numbers mean in a bit. But, an order flow chart allows you to see market-generated support and resistance information. Market-generated information that comes from, what's actually traded in the market, volume-wise, is more powerful than just where the market opened, where it closed. And it's, you don't really understand it until you start looking at it and putting the pieces of order flow together. And it really is like, solving a puzzle. The puzzle is the market. And when you have more pieces, the picture becomes clearer. Now, there's some people will argue that order flow trading is not a volume footprint chart trading. This is what a volume footprint chart is. They will say, no, depth of market, the price ladder is order flow. And they'll say that because, they think that they found some secret holy grail to trading. What depth of market is focusing on orders that are going into the order book that haven't traded yet, where the volume footprint chart focuses on what actually traded. Now again, I've traded for 20 years. I've stared at a dome for 20 years. Volume footprints didn't come around until the mid 2000s. Probably the earliest format. There was crude formats back in the 1990s, but no way now compared to what we have now. But what I trade the volume footprint. I trade based on what actually trades. And there's a big difference between what actually trades and versus what people are putting into the market and not trading. I'm going to show you, I'll explain that in a minute. It's going to be very clear to you. Now this is a dome, okay? This is a volume footprint chart. So I could see what the volume was that traded on the bid at a price, what the volume was traded on the offer at a price. Now a dome just shows you what the bid is, what the next best bid is, what the volume is at the next best bid, and same for the offers. It shows you where the market's offered at the next offer with the volume. And really what people are trading a dome is they're looking for big orders to come into the market. Well, I got news for you, right? If the market is 5 bid at 6, it's trading 5 bid at 6, 31 on the bid, 100 on the offer. Yeah, a lot of people, I would love to sell at 8, but the market's not going to trade there. As the market starts ticking up, these people that are trying to sell at 8 realize that, oh, the market's going up. They pull their offers. So if you see a big offer come in, the market's 5 bid at 6, someone sees 300 come in at 8, they start selling the 5s. Oh my gosh, there's a big seller up here. Well, of course there is a big seller up there. If the market's 5 bid at 6, and someone thinks they could sell it at 2 ticks higher, they're going to try and sell everything they can, because if they could sell it at 8 and buy it at 6, that's great, happy days. And that's one of the most misleading concepts of the market. I'm going to share with you a piece of information I learned very early on. in this industry is size attracts size. And I didn't realize how important this was until I left the floor and was trading for a big trading company, and I had started trading big size. Okay, most people that trade on a dome, they see a big order come into the market and they think, oh my gosh, this market's going to react and it's going to sell off. Well, the only people that sell off are the stupid traders, right? The retail traders that are thinking that, oh my gosh, there's a big seller up in here, I'm going to jump in front of them, and sell some and buy it back a little bit lower. As a big trader, and I speak this from experience, and I know a lot of big traders, and we all think alike, if the market is 5 bid at 6 and I see there's 300 offered at 8, to me, I'm happy because I could finally get my position on at a reasonable price. I'm fine to buy the 50 contracts offered at 6, the 35 at 7, to get that 300 there offered at 8. So, just because you see a big order come into the market, don't necessarily mean that the market's going to move in the opposite direction. Size attracts size. And, when most people watch videos on dome, they think, oh, this is the life. This is what I'm going to do. I'm just going to stare at 20 different domes, every different market. Come on. Be realistic. Can you do that? This is why a lot of traders fail. They think, well, if I could play one guitar, I could play 5 guitars at once. No, you concentrate on one thing. This is very, very few traders get to this level, honestly. And, I just I shake my head when I see, when I talk to traders and they're like, send me a picture of your screenshot. And they send me something like this with 20 charts open, or even like these other charts there, or these bar charts. I'm like, my God, you're killing yourself. Concentrate on one thing, because what trading on a dome is really like is this. Imagine you're looking at this all day and you see all these numbers flashing up. It's like being in a casino, right? You might as well just be playing a slot machine, which is, for a lot of people, that's what trading on a dome is. So let me ask you, would you rather be? Would you rather be the trader trading with the flow of the market, the volume footprint analyst, or the trader playing catch up to the market using traditional technical analysis, or the trader trying to guess what might happen in the market based on orders going in and out of the order book using a dome? Again, the big difference between trading a dome, the depth of market, versus trading a volume footprint chart is what you're basing your trading decision on. A volume footprint trader makes their trading decision based on what actually traded. The information used is based on what actually traded in the market. When a trader enters into a trade, he is making a commitment to the market. A dome trader is trading based on what's happening in the order book, with orders that have not yet traded. It's just orders being placed and canceled, and sometimes they're being traded. When a trader places an order that's not executed, there's no commitment to the market. It would be like saying, if you follow football, okay, well, it's one thing to look at a record, for Manchester United. Say, oh, they've won the last 10 games. Well, chances are they're going to win the next game. Whereas, at the beginning, if a dome trader is not going to look at that record of seeing, oh, they've just won the last 10 games. They're just going to look at the talk of the players. Oh yeah, we're confident of, it could be QPR or something, who, not a good team, but the players are full of energy and confidence. Oh yeah, we're going to take on Manchester United. We're going to beat them because we're just a better team. Well, you look at the record, right? You look at what's traded. You look at the games they've played. If their record is they've won 3 out of the last 10, you're not going to back them. And it's the same thing with trading. You're going to look at the record of the team and make a decision based off of that, rather than just the talk of the team. You're not going to. You're better off placing your bet on the team that has the better record than the team that talks the most. And it's the same thing in the markets, right? You're going to look at the volume that traded rather than, people's intention. Now, surprisingly, something that's not talked a lot by dome traders, I don't know why, is, it's the games that traders play with the order book, right? Spoofing or layering. It's an illegal practice that traders do all the time. And what it is, it's orders that are entered into the market with the intention to manipulate market direction in the short term to take advantage of other traders who are playing by the rules. Spoofing is illegal. Now, A quick example, there are different types of spoofing, but a basic example is this, right? Say the market is trading at 131.25 and the spoofing trader wants to sell at 131.30, but the market's trading 25. So what does he do? Places an order to sell 25 contracts at 30, and at the same time he places an order to buy 1,000 contracts at 131.24. Other traders see the big order for 1,000 contracts at 131.24 and immediately start buying the 131.25, the 26s, the 27s, 28s, 29s, and 30s. Eventually, the trader was able to sell his 25 contract at 131.30. So what does he do? Is he cancels his order to buy 1,000 at 131.24, and what happens to the market? Immediately drops back down to 131.25. So all those guys, all those suckers that saw that big order to buy 1,000 at 24 started buying the 25s, 26, 27s, 28s, 29s. But then instantly the market drops back down to 25. So all those people that bought at 26, 27, 28, 29, 30, they're left holding the bag. They just got suckered. They just got fooled by someone playing a game in the market. And if you don't think, I say, oh, Mike, that's rare. It doesn't happen very often. It happens. They're really cracking down on it. They're getting 15, 20 cases a year that are being settled and prosecuted, people going to jail literally and paying, millions of dollars for it. Here's this case just from 6 months ago. CME settles spoofing charges. This guy had to pay $90,000 and he had a 30-day suspension. You can't trade. But what he was doing, was small. He was just placing bogus bids and offers. He was layering stuff into the order book, right? It was what they call disruptive trading, by layering orders in the soybean futures markets without the intent to trade. Then he would cancel them instantly. But in the meantime, traders would be making decisions based on these fake orders that he was placing. This is a bigger case. Now this is a guy, he's a Chinese guy living in Sydney, Australia, Jim Zhao. And what he was doing was this was going on for years, right? This is just dated earlier this year, Monday, January 28th, 2019. For almost 4 years, this guy placed thousands of phony orders in the E-mini S&P futures that he never intended to execute, all in an effort to fraudulently move the market to his own advantage. Okay, so, it gives you, this is from the U.S. Department of Justice, right? This is not, some Chicago court. This is the Department of Justice. They had to go get this guy living in Australia and bring him to the U.S. What he was doing, he was, he says here, trading strategy was intended to inject materially false and misleading liquidity and price information into the E-mini S&P futures contracts by placing spoof orders in order to deceive other market participants about the existence of supply and demand. Spoof orders were designed to artificially move the price of E-mini S&P futures contracts in a direction that was favorable to Zhao and to the detriment of other market participants. Okay. Here's one from, just 2 months ago, May 2019, talking about spoofing. Okay, spoofing is placing an order for a commodities trade with the intent to cancel the order before it's actually executed. The goal is to affect the price of the commodity and benefit a pre-existing trading position. Now, what's interesting about this case is rulings in prosecutors' favors would support their efforts to charge individuals for spoofing trades dating as far back as 10 years instead of the normal 5 or 6 years. So, people have been doing this for a long time. They want to go back and get everybody. It's just not one or two guys. They want to expand it and, make their net bigger. Here's a guy. This is, he was trading currency futures on the CME. This guy got, what he was doing, spoofing, involves placing bids or offers to sell futures contracts with the intent to cancel before execution. By creating an illusion of demand, spoofers can influence prices to benefit their market position. This guy was making a lot of money doing it, making $150,000 per month. And what did he got? He was sentenced to 2 years of supervised release from jail. I think at one point he was facing like 3 years in jail. So, again, ask yourself, what would you rather trade? Would you rather trade orders that are going into the book that could potentially be misleading you? Or would you rather be trading stuff, making your decisions based on what actually traded in the market? Things that matter, as opposed to smoke and mirrors, things that are potentially not real. So think about it, okay? What would you rather trade? You got to trade based on what's actually traded in the market. So let me ask you again, would you rather base your trading decision on trades that actually occurred, which is what you're seeing on the volume footprint chart, or would you rather trade on a dome, or orders that may be entered with the intention of manipulating you into doing something you should not do? You know, would you rather play with somebody that's got a deck of cards that is not marked, or somebody that's out trying to play with you on cards with a deck that's marked, that he can see what cards you're holding because he's got some special glasses or something like that? Of course not. You're not going to play with the guy that is out to cheat you. Now, I'm not saying that all the activity going on in Dome is out to cheat you. No, but there is potentially a percentage of that stuff. Even if it's just one trade out of 100 that you take, you're involved in someone doing something illegal. That's one too many times. Okay. But anyway, again, that's a decision you have to make. I think it's in your best interest to stick to what actually trades in the market as opposed to what's not being traded in the market, and basing your trading decision on that. Again, that's a personal decision. That's up to you. Again, I've looked at a Dome. I've looked at Domes since they started in the 1990s on the electronic trading systems from the exchanges. They had Domes back then. And I just find it's better to base your trading decision on what actually happened in the market. So take it from me, I've got over 20 years of trading at very high levels in the industry. JP Morgan, Cargill. You don't survive for 20 years at JP Morgan, at Cargill, at Commerce Bank, etc., unless you know what you're doing, right? And that's how successful traders survive, is they know what they're doing. And that's why I'm doing this presentation, is to give you that knowledge that I've learned over these years. So the Order Flows Trader software, which I developed, is a unique charting tool that enables a trader to observe the two-way auction process that drives all market movements, the ebb and flow of trades occurring in the market, in a way that reveals patterns in the herd behavior, what everybody else is doing. Are buyers in the market, or are they absent? Are sellers being aggressive, or are they backing off? So, that's all information that you want to know as a trader. So what I'm going to talk about first is the building blocks of order flow analysis that I think you really need to master. And it's from this that, once you focus, whether you're new to order flow or, you've looked at order flow chart, you have to have the basic building blocks. There are 3 building blocks. You have to understand them so that because all your future trading decisions are based off of them in one form or another. And what they are is the point of control, is delta, and its imbalances. Now, I'm going to explain them in depth separately. So they all appear on a normal order flow chart. Okay, point of control, every bar has a point of control. Every bar has a delta. Imbalances, not every bar has an imbalance, but when they appear, you got to pay attention to them. So the first one I'll talk about is delta. Now, delta. Now, earlier I talked, the difference between aggressive buyers and sellers versus passive buyers and sellers. Now, remember, there's 4 types of buyers and sellers. You have aggressive buyers. They're the people that buy at the market. They want to buy now. They want to get into this position. They don't care what price they're going to pay. Aggressive sellers sell at the market. They want to sell now. They want to be short the market. Passive buyers are those that work a bid. They want to wait for the market to come to them. Passive sellers sell on the offer. They wait and let the market come to them. They're happy to sell at a higher price. They may not get filled. Passive buyers, passive sellers may not get into a trade. Aggressive buyers and aggressive sellers will get into a trade. Now, how it registers in delta. Now remember, right? Aggressive buyers buy at the market. Aggressive sellers sell at the market. Markets move as a result of the aggressive traders. So in delta, an aggressive buyer registers as +1. An aggressive seller registers in the delta as -1. And delta is going to show up in the chart at the bottom. Down in here, you can see delta, this line right here. Positive 638. Okay, you're at your low of the day. All of a sudden, you got strong positive delta. aggressive buyers are coming in here at this low of the day, buying 638 net aggressive buyers. That's very important information. I know that at this low of the day, anytime you're at your low, you're wondering, are we going lower or are we going higher? Are we going to start to rally off this low? So I know that if we're at this low of the day and I see a very strong positive delta, I know aggressive buyers are coming into the market thinking this price is low. And you see how the market rallies up. This is the gold market, right? It's a 5-range chart. Now notice it gets up to this high and you got negative delta, minus 90. So now all of a sudden on this market's going up, right? You got positive delta, positive delta, positive delta. Then you get up here, you got negative delta. Well, oh my gosh, what's happening? Sellers are taking over. And what happens? Sellers take over. Market's going to move down when sellers are in control. Now, there's different delta readings, right? So you can have the delta, which I just explained to you here, this top number. Now, there's a couple other numbers. There's max delta, which is the strongest delta was positive in the bar. So like, for example, you can see this bar here at the low, 638 is the final delta. The max delta was 646, meaning we closed right up near our high for the delta in the bar. So at one point there was 646 aggressive buyers. It settled at 638. The min delta is the number, is the opposite. It's the lowest delta was in the bar. So you can see here, negative 66. That means that, yeah, early in the bar there was a little bit of selling because it was negative, minus 66, but it went from minus 66 all the way up to 646. That's very bullish. Just as, for example, this bar over here, right? You see the delta minus 828, max delta 0. There was at no point in this bar were aggressive buyers ever in control. Min delta is minus 846, which is the most negative it was in the bar, and it closed at minus 828. So it's very negative in the sense that aggressive sellers are dominating this bar. There's also cumulative delta. I don't have it on this chart actually. I don't really use it, but it just tells you it's the running total of, it's like an average. I'll say the average, but what you're doing is you're taking, like here, minus 304 plus 270. You just do the math and it just gives you, it just tells you, when, because most of the day it'll be positive or negative, and there might be a couple times during the day where it flips from positive to negative. But I don't use it. In other presentations, I talk about why I don't use it. I just like to look at it on a bar by bar basis. Now, order flow delta is important because it shows you hidden strength and weakness in the market. If buyers or sellers are dominating, and it's going to tell you market generated turning points. It's going to tell you if prices are being supported or defended, and much more. This information is not available on a normal bar or candlestick chart. For example, if you're just looking at a chart, oh, where's my chart here? This, you're not going to know when aggressive sellers are in control here or aggressive buyers are in control, because that information, it's not there. Now, that information you could get, right? That's why I like the OS Trader data feed, is because I can see that information. It allows me to see that when buyers are in control. Like, if I'm looking at this, wow, it's a big green candle, big up candle, we're going higher. I get all excited, but then, oh my gosh, I got a red candle. Well, what's going on in this red candle? I want to know, are sellers really taking over or what? Or is this move stopping and we're just going to go sideways? It's going to give me that information, hopefully, in the order flow. So, that's the difference between looking at a normal candlestick chart like this as opposed to looking at a footprint chart. You got a lot more information in there. So, think about it, right? How is order flow delta useful? Is, remember, there's never more buyers than sellers or sellers than buyers. They're just more aggressive ones. Right? Order flow delta shows you shifts in supply and demand. Who or what really moves the market? It's supply and demand, and it's driven by the big players, right? So, next question is, well, who are the big players in the market? Tell me, Mike, who are they? Well, it's the commodity trading firms. The people that, manufacture or grow the commodities. It's the asset managers, the real money accounts, by the sovereign wealth funds, CIC, China Investment Corp. It's the hedge fund portfolio managers. Sometimes they're passive, other times they're aggressive. But you know what? Everything they do is going to show up in here. Okay? Once they trade, it registers. The volume is there. It registers on the exchange. It's there for the whole world to see. Then you could start taking these pieces, putting them together, and formulate a trading plan and take good trades off of it. You know, remember, there's different types of buyers and sellers. There's passive and aggressive participants. You know, who are the aggressive participants? Well, they're the traders who are getting in now. Who are the passive participants? They're the traders who are letting the market come to them. So, you know, remember, markets move up on aggressive buying. Markets move down on aggressive selling. Moves up stop when they're met with passive sellers. Moves down stop when they're met with passive buyers. So just for example, here's AG. This is AG is what, silver. As a 1 minute chart, you can see as we're moving up, right? You can see the strong positive deltas here, 1,300, 3,200, 1,300, 4,000 as we're moving up, right? Markets move down on aggressive selling. You can see here, starts out a little slow, minus 10, minus 38, minus 58, 68, 54, 122, 464, 3270, as you're making this move down. You know, so there's just so much information that you can use as a trader. ZN. This is zinc. This is a 1 minute chart. Markets move up when they're met with, markets up stop when they're met with passive sellers. You can see that right here, right? This move up was met with passive sellers. This 190 contracts up here. That's a big number up here, right? Even here earlier, you had 190. That was your first sign. You know, we got through that. Then you got another big order sitting up here. Market reacted and sold off. Markets move down when they're met with passive buyers. You know, look at here, right on this low, 3,826 contracts traded. Do you see, how often in any of these bars do you see a volume like that? You don't see that. You know, in here you've got 5,200, but looking at all these other bars, I don't see that type of volume. There's a strong buyer down here, a strong passive buyer saying, yeah, sure, I'm happy to buy it at 85. You know, we're trading here at 39.05. The guy's got a big bid in there. Boom, market spikes down. He just bought everything. He's happy. The market starts moving back up. But this is what I mean by strong passive buyers. You know, someone that's waiting for the market to come to them. Market came to them. He's happy to buy it. And then the market moves up, right? He's there. He's probably happy to buy some at 85. He's probably happy to buy some at 84, 83. These are passive buyers. This is a big passive buyer. This one, it just sticks out like a sore thumb. You know, how can you not see that information? Now, if you're looking at a bar chart, you're not going to see that information. If you're looking at a volume footprint chart, it's there. It's plain as day. So aggressive buying moves the market up. Aggressive selling moves the market down. There are never more buyers than sellers. There's just more aggressive ones. And you're going to see that in the delta. Now, the next point I'll talk about is point of control, also known as POC, and it's the price level in a bar where the most volume traded. You know, the POC is measured horizontally and accounts for both volume traded on the bid and volume traded on the offer. Now, what makes point of control, POC, so powerful is it often acts as immediate support or resistance. You know, every bar has a point of control. I put arrows on some of them here just so you can see how point of control, okay, so you're at your low here, point of control, next bar, it goes higher, it comes back within 2 ticks. Next bar opens up, it comes back to the tick of that previous point of control. Next bar within 2 ticks of that previous point of control. Next bar right to that tick. Then the market flips, it starts trading down. You have your point of control up here. Market opens up down here, rallies up within 1 tick of that point of control. Market rallies within 2 ticks of that point of control, within 1 tick of that point of control, within 2 ticks of that point of control, within 2 ticks of that point of control. Then it flips here, starts going back up. It's within, you know, the point of control now is here. You know, imagine being able to know, right, where the next bar is going, has a very good chance of stopping and reversing, right? We've often, you know, people have probably spent decades trying to figure out, okay, well, where is this bar that hasn't formed yet? Where can it stop and reverse? Well, just look at the point of control. That's going to give you that information. It's plain as day. You know, there's no mysticism there. There's no alchemy. You know, you're not trying to turn base metal into gold. It's just information right there. The reason why it stops and turns is because that's where the volume was, right? That's what stops moves oftentimes, is big buyers and big sellers, big activities. You know, another way to look at volume is think of volume in terms of value. You know, where the most trade occurs is where something is valued at. Point of control also helps you in a move determining, is this move going up? Here's a market. It's going sideways here for the most part. And then notice this bar, this big green bar here. Point of control, next bar higher, next bar, point of control higher, next bar same, next bar higher, same, next bar higher, higher, same, higher. Comes off a little bit here. Then boom, next bar higher, next bar higher, next bar higher. As point of controls are migrating up, that means the value is also going higher, right? I just talked about, think of point of control as value for the bar. When point of control is migrating up, generally the move is going to be going up. You're not going to get higher point of controls on a market that's going down. Just as a market that's moving lower, point of controls are going to be going down. And notice how, each of these bars, pretty much as you're going down, where does it come to? It comes to the previous point of control. It gets within one tick of that point of control. Okay, here it gets a couple ticks through. Next two bars pull right up to that point of control. Next bar within one tick of that point of control, and so on. That's just information there you're not going to see on a bar chart. Now, every bar has a point of control, and it can appear at any point in a bar. But there are times when it appears at a particular level that often indicates a turning point. And you can see it down in here. It's point of control, so I call point of control on the extreme. It's heavy volume on the low here. Yeah, you did get one tick through it. Okay, it's not the end of the world. But this is going to be your turning point, right? One of my favorite trade setups is that particular trade. And this is something that's unique to my software. I have what I call prominent point of controls, which highlight point of controls that matter, right? I said every bar has a point of control. But when I see one that's blue like this, that's bullish. If I have a red one, that would be bearish. So this is very bullish right here. I know I can be buying it anywhere around this point of control is a great long entry. And you can see how if you bought it here, boom, the market made this nice parabolic move up, right? Here's another one. Again, if you're buying it in the next bar at some point, right before the big move up. Here's a sell, right? The red color point of control. I said normal point of controls are just going to be gray color, like here you see here, NI nickel, right? What's this other market? MA, what's MA? Methanol. I'm just showing you on different contracts, right? I is the what is that? Iron ore. So you're seeing it in different contracts. 1 minute chart, 1 minute chart, 1 minute chart, different commodity contracts. It's not like, well, this only works on this type of contract or something. No, I'm showing you different contracts it's working on. Same chart duration, 1 minute, 1 minute. I'm not saying, oh, you got to look at this one on, a 5 minute chart and this contract on a 1 minute chart. I'm showing you how it works in different markets on the same time frame. I'm using the same parameters. And you see, prominent point of control, a bearish one, it's red color. Okay, the bullish one is green color. Okay, you notice how this next bar, it came right up to that level, sold off. And over here, it came within one tick of that level and then sold off. Here's one I just sort of skipped over, methanol. Again, prominent point of control right here, right before the market sold off. Now, the last thing I'll talk about is imbalances. Now, imbalances are important because when they occur, they can tell you who's in control of the market. And where imbalances occur is important because it can signal shifts in market sentiment. Now, you'll notice this is a volume footprint chart, and inside the bar, right, the numbers inside the bar, you'll see some are blue, some are red. If it's a red number inside the bar, that's a selling imbalance. If it's blue, that's a buying imbalance. So you see generally on moves up, you're seeing buying imbalances. You may see an occasional selling imbalance. That's normal. On moves down, you're going to see selling imbalances. Sellers are in control. You see 3 in here. You see 1 here. You see 3 here. You see a couple buying imbalances. A bearish point of control right here. And the market keeps going down. So an imbalance occurs when aggressive buyers overwhelm aggressive sellers in the bid-ask by an amount determined by you, the trader. You can make that decision. Most traders use a minimum of 400%, which means there has to be at least 4 times as many aggressive buyers versus aggressive sellers in the bid-ask, or on the other side, 4 times as many aggressive sellers than aggressive buyers in the bid-ask. And imbalances are important because when they occur, they can tell you who's in control of the market. When imbalances occur, it's important because it can signal a shift in market sentiment. Now again, imbalances occur when one side is more aggressive than the other. Either there's more aggressive buying or more aggressive selling. Now, imbalances by themselves show aggression at a price, but when you start seeing aggressive trading in bunches or groups, it's going to take on a much stronger importance. So, for example, you're at your high of the day in this bar right here, and I see a bunch of aggressive selling coming in this bar. 1, 2, 3, 4. It's all stacked nice and neatly. This is what's called a stacked imbalance. Okay, and that's a very bearish sign. You see another one over here, right? Notice how this is an area where there's aggressive sellers, and oftentimes what you're going to see is anytime you come back into that area, the aggressive sellers should defend that area. You can see it here. You can see it here. And what makes imbalances so important is because it gives you an opportunity to buy or sell. That's a very high level of opportunity. But the risk is at its lowest level because I know that I've got aggressive sellers here. The market is telling me at these price levels there were aggressive sellers. So I know that if I get past that area, those aggressive sellers aren't there. So if we're coming back into this area and I still see these aggressive sellers defending that area, and how do I see it? I see it by the market reacting. Market coming into that area, selling off. Coming into that area, selling off. That's telling me that these aggressive sellers are still there. They're defending this price area. If we start poking our head on the other side, I know the aggressive sellers aren't there. It's time to get out of the trade. It's not like placing a stop way up here, 20 ticks higher, 10 ticks higher. No, my stop on this trade is within 2-3 ticks. Okay, so my risk is very low, but my opportunity is very high because I know that if this area is defended by strong sellers, it's got a big potential to make a big move down. But if I know that these sellers are no longer there defending this price, that's it. I don't want to be in the trade anymore. Simple. So if you trade order flow on a regular candlestick chart, you can't see too much information other than where the market was. And what do I mean by how people like to say, well, I trade order flow, then they show me their chart. It's a candlestick chart. Well, that's not order flow. You're trading just basically price. Price is an advertising mechanism to draw people to the market, right? If prices are low, it attracts buyers. If prices are high, it attracts sellers, right? That's what looking at a candlestick chart is. But when you're looking at an order flow chart and how it's made up, right? You can determine if there's an imbalance, what's causing the imbalance. It allows you to see what's happening in the market right now. When you're looking at this candle being formed, you see this imbalance. That's your opportunity to take the trade. You take the trade now. If you're using a moving average, you'd probably be getting short somewhere down in here rather than getting short somewhere up here near the high. Now there's what we call stacked imbalances, okay? And a stacked imbalance is when there are 3 or more imbalances stacked one on top of each other. This is a stacked imbalance, okay? If you're looking at a normal bar chart, you can't see where imbalances are occurring, right? If you're looking at this bar chart here, right? If you put your hand over the right-hand side after this candle forms, this is a very bullish candle, right? This is the hammer candle. People call them pin bars, Pinocchio bars, whatever. It's a hammer. And this is a very bullish bar. People will say, well, price probed down here, ran the stops, traded back up, look for the market to go up. Well, what happened? It didn't go up. You got a big red candle. You took out that low, went lower. Okay, you went from 4,000 basically to 39.60. You just sold off, made a big move down. Okay. If you're looking at an order flow chart, you see this stacked imbalance here. You got aggressive sellers here. So even though you got this pin bar in here, say, oh, I got a pin bar, I can't get short. It's a pin bar, it's very bullish, right? You want to get long, but you got this right above the top of this pin bar. You've got a stacked imbalance. If we don't start trading up through this price area, the market's not going to go higher. Instead, what happens? The market sells off. You can see the market can't even take out this high here. So I know I had the selling pressure earlier. We rallied back up here. We can't even get into that area. where this aggressive selling was. Instead, the market gets whacked. It gets sold off pretty aggressively. You actually got 1, 2, 3, 4 imbalances in the bar. They're not stacked neatly on top of each other, but it's still multiple imbalances in the bar. And what happens? The market goes down, keeps going down, right? So, order flow would have kept you out of, if you're a candlestick trader, order flow would have kept you out of this losing trade, because like I said, at the time, this was the low of the day here, right? When you see this happening on the low of the day, that's a very bullish candlestick chart. The thing with candlesticks is when they work great. When they don't, they don't. And it's almost like a 50-50 proposition, flipping a coin, on when it's going to work and when it's not going to work. Why put yourself in that position? Give yourself a better edge by looking at the order flow, saying, oh, I got aggressive sellers here right ahead of this pin bar. I probably don't want to be getting long here unless we start getting through that area. What happens is we don't, and it's going to give you actually a nice trade to get short, because you got that overhead selling up there. You don't want to be buying into selling, on a market that's selling off, and makes a nice move down, so you can profit from it. Now, my Order Flow Trader software has a feature on it, and it's called the multiple imbalances. Now, there are stacked imbalances, right? Like you see here, 1, 2, 3, 4. These are stacked nice and neatly on top of each other. There's a box around it. Anytime there's multiple imbalances, whether they're stacked or not, it's going to put a box around it. Stacked imbalance will have, this nice little zone printed out, which is nice to see, so it's a visual thing. This is what's called a stacked imbalance. Now, go back here. This is what's called a multiple imbalance right here. This red bar has got 4 imbalances. They're not stacked on top of each other. There's just normal order flow in between, normal numbers between the imbalances. But what my software does is it puts a box around it, which tells you, hey, there's multiple imbalances in there. You got to pay attention to it. Now, this is a red candle, so I'm not really too concerned with these buying imbalances because it's a red candle. I'm looking in the direction of price being traded. Okay, if this was a green candle, I'd pay attention to these buying imbalances. But you can see this is a signal here telling you to get short. And what happens over the next 2 bars? You sell off nicely from 39.80. It's a 1-minute chart. Opened up at the high, closed on the low. And next bar, followed through. So there was a nice trade to be had there. Stacked imbalances often create support or resistance in the market. Stacked imbalance are here, right? You can see how the market came within 1 tick of it. So stacked imbalance, market sold off, came back up here. Where did it come back? Came back up to that stacked imbalance here. Okay. But just real quick, I want to show you the strength of multiple imbalances. Because like this chart here, right? You don't have stacked imbalances. But what you have is multiple imbalances. You got 2 imbalances here, then 2 price levels with normal order flow, and then another buying imbalance here. This is what's a multiple imbalance. That's why there's a box drawn around it, right? It's a bullish sign. You see the market goes higher. Then you get up here near the high. You're at your high of the day, no imbalances. But then you come back within 2 ticks of the high, and you got multiple imbalances. You got the box around the bar, 208, 702, 134. Now, if you're waiting for stacked imbalances, you're not getting anything in here. But this is what the beauty of my software does. It alerts you to multiple imbalances, which are just as important as in stacked imbalance. And you can see how the market sold off. What's that information worth to you as a trader? You got to ask yourself, that's, can I use that in my trading? Most people will say yes. If you can't, I think you should readdress your trading style. But that is a very important feature that a trader can use in their analysis. Imagine you're at your high of the day and you've got a very strong reason to be getting short. That's a trade you got to take 10 times out of 10 times. You're not going to win 10 out of 10. Yeah, you might win 7 out of 10. You might win 6 out of 10. But you're at your high of the day. What's the potential for the trade to go? Potential is to the low and lower, right? You got to be asking yourself, is that a profitable trade? For example, here's, multiple buying imbalances as we're going up, multiple selling imbalances as we're going down. So, order flow allows you to break free from traditional thinking of market analysis that has been holding you back from being a successful trader. Everyone, I know a lot of people that are borderline traders. They love to trade, but they just can't really be consistent on it. And order flow helps them become more consistent. Delta, the imbalances, point of control, help you determine whether trading activity is drying up, being facilitated, or if it's increasing in price. And this information is priceless because few other traders have access to it, let alone understand how to interpret it. And I'll be honest, in China, there aren't very many people using order flow in their analysis. It's like such a ripe market. Now, unfortunately, to trade the Chinese market, you have to be either a Chinese person, you got to be living in China, or you have to, if you have a company, it has to have been domiciled in China. You can't just go there and open up a company in China and start trading the markets there. No, it has to be a company that's been in existence for a while, for several years, I believe, before you can start trading it. There are ways that people can trade it, but it's such a ripe market, and if this presentation just gets a handful of people, they can do really well over there. It's like shooting fish in a barrel. I mean, imagine having access to market information that's available to everybody. This is not some secret information. It's available to people if they want to look at it. And the amount of people that are looking at it right now is so small, that you're going to have the edge, right? Everyone always says you have to have an edge in the markets, right? You have to, have a way, something that nobody else can see or follow the markets. This is that edge. This is a huge opportunity for traders to take advantage of. It's like having, an old car versus a new car, basically. You'll be competing against people using technical analysis from 50 years ago while you're on the cutting edge. It's like using an Apple iPhone as opposed to using the old Nokia phone that you could play Snake on. Now the iPhone you can play all these fantastic games on, whereas don't live in the past, live in the present, live in the future, get ahead of everybody. As traders, think about where the market is attempting to go and how it's trading to get there. That's what order flow allows you to do. As a trader, you should always be thinking about who is more aggressive, the buyers or the sellers. Is the bid or the offer trading more? You got to be asking yourself that, because that's going to determine where the market's going. If the market's moving in a certain direction, you got to ask yourself, is the current trading activity being sustained? If you're in a trade, how is your trade entry looking? Are you making money? Are you not making money on the position? You got to keep asking yourself these questions as trading is going on. One of the major reasons many traders fail is because they have a habit of just following price. They see where the market opened, they see where the market closed yesterday, and they watch the price move up and down all day. They have this assumption that all prices are equal. Truth is, not all prices are equal, and order flow allows you to see what's going on at different prices, right? That's like saying all people are equal. Well, some are tall, some are short, some are fat, some are skinny. I'm taller than my wife. My 5-year-old son is taller than my 7-year-old daughter. And in the market, it's the same. It's not all boys are taller than girls. Sometimes girls are taller. And in the market, what differentiates price is the volume. Volume helps you decide whether price action can be trusted. For a market move to continue, there needs to be other traders also trading in that direction. Otherwise, the move is going to end pretty quick, right? Volume helps confirm the trend direction. So for example, right, this is rapeseed meal. Okay, this is a 5-minute chart. It's trading massive volumes, 40,000, 50,000. But you're at your high of the day, okay, and you're seeing there's a lot of trading activity. But in this area where the market sort of slows down, going sideways down in here, volume is much lighter. 10,000, 7,000, 11,000, 6,000. Better example, eggs. I love the egg market. There's a great story about this ex-soldier who made millions trading the egg market. So it's a legitimate market. But look here, you're going sideways. Okay. Well, what's going on in the volume? Traders aren't active now. They've dried up, so to speak. 1864, 858, 2000, 1400. When normally you're getting 3,000, 2,500, 2006, 2007, 2,900, 4,000. Your volume in here is much lighter. Trading activity has quieted down in here as this market goes sideways. Notice you have a stacked imbalance. This one failed. But what do you got here? You got multiple imbalances here. Again, very bullish sign. This one, this is what happens, right? Where were the people defending this price? They weren't there anymore. Why? How can I tell? Well, the volume is much lighter. right? You don't see the heavy volume in here. And what happens? Price moves up. Then the aggressive buying comes in here. 1, 2, 3, 4, 5, 6 buying imbalances. Look at the volume. 4,000. Boom. Market goes higher. That's very bullish sign right there. Order flow is telling you aggressive buyers are coming into this market. Position yourself long and get a nice trade out of it. Here's CSI 300. Look, the market's going sideways, then the market makes a move. When the market's going sideways, look at the volume, 51, 82, 89, 82, 77. As the market makes this big move down, what's the volume? 300, 200, 100, 190, 170, 400, 379. Volume is very important. Not all prices are equal. It depends on the volume. I'll be honest with you. We're living in a wonderful time for traders. Technology has made it possible for a regular trader to be successful. The low price of computers, data, and information, you're on near or equal footing as a professional trader. Order flow combines price and volume into usable information that can swing the odds in your favor. The purpose of the order flow volume footprint chart is to leverage the massive amounts of data produced by the electronic markets and provide traders a better visual way to have greater insight and transparency to what is happening in real time, giving you an edge over other traders. Most traders are weak in analyzing the present. They're great in analyzing the past. Everyone wants to talk about what happened in the past. They show charts of what happened last month, last week. But you don't trade in the past. You trade in the present based on what's happening right now. You have to get in and out of the market in real time. So it makes sense to analyze the present as good as you can. So if you're using traditional technical indicators, you're not analyzing the present. But when you're analyzing a volume footprint chart with all the information available, you're analyzing what's happening right now, and you can make those decisions as you're looking at the chart, as the bar is forming, to make a good trading decision. So I'm going to wrap it up here. If you're interested in China data, go to my website. If you're interested in the volume footprint chart, go to my website. You can go to http://orderflows.com/OS-trader to find out more about OS Trader data, as well as my software, my volume footprint, my order flows trader software. It will run on the free version of NinjaTrader. So if you're interested in trading the China market, if you're interested in analyzing the China market, this is how you do it, period. So thanks everyone. Have a great day and bye-bye.